Okay, so we'll get started now. Welcome everyone to the webinar. My name is Ketan Khandkar, and I have also with me Martin Stein from Blackford Capital. We'll do a quick round of introductions, and I'll cover the agenda, and then we'll go into the actual content of the webinar. Just way of introductions, I am a co-founder at Navatar Group, and I will be moderating today's webinar with Martin. The agenda for today, the focus is on the private equity firms. What are the challenges, especially smaller firms, face today in the marketplace, how they are using strategies to differentiate themselves, including technologies like cloud computing and social media. We want to see if they are really helping or is it just a buzz, and to help help us go through the details and also give their perspective is Martin Stein from Blackford Capital, who is the main presenter today. Before I introduce Martin, just quick logistics. All of you are right now in a listen-only mode. However, if you have questions during the webinar today, there is a questions panel where feel free to enter and ask any questions. We will collect all the questions, and we will leave enough time at the end to answer all the questions. We're expecting that the presentation will take about 35 to 40 minutes, and then the remaining time will be to go over any questions that the people have today. So let me introduce Martin. He's a managing director of Blackford Capital, and I'll turn it over to Martin to kind of introduce himself and his firm, and then we'll go into the details of the webinar. I will also make him the presenter. So Martin, if you don't mind giving a quick introduction to your firm as well as yourself.
I would be happy to do that. Thank you very much, Ketan, for the introduction. I'll make sure I've got the right screen up there. Should be my background now.
That is correct.
Perfect. Excellent. Well, it's pleasure to be doing this presentation with Navatar. We've been very impressed with the functionality of the product, and as Ketan mentioned, they're going to go through a lot of different components. I'll go quickly through my background in a minute. Just want to reiterate, as Ketan mentioned, the interactivity of it. Would very much appreciate it if you could ask questions via the webinar functionality. Obviously, everyone's on mute, so it'll be hard to hear those questions directly. But it's going to be a lot more interactive and engaging and fun if we can get your participation on it. I may occasionally tell a joke while I'm talking. Fortunately, I can't hear anyone, so won't know if you're laughing. I'll just assume that the joke is funny, and we'll keep moving on with it. I do see from the attendee list that I've got a number of folks that have worked with over time, and then some new people there. So thank you all for participating. And again, really hope that this material that we pulled together is helpful for you and of benefit. So my background, Martin Stein. I'm a managing director and the founder at Blackford Capital, undergrad University of Chicago, and business school at Harvard. Had done some work on the consulting side and manufacturing prior to getting involved with Blackford. And over the last period of time at Blackford, I'm responsible primarily for our deal sourcing efforts and on the transaction side. I also do currently chair 3 of our portfolio companies. I'm on the board of 3 others, but spend a good bulk of the time working through how we can find the best companies and make sure we're acquiring them in the best structure and at the best price. We've actually been involved in a number of different functions via ACG and Capital Roundtable and some articles on deal sourcing, and feel that's a particular strength of our firm. And so it's, again, exciting to sort of showcase that and what we've managed to do with Navatar. So on our firm, we started the firm in 2000, had our first initial transaction from 2001 to 2005, and then moved to a portfolio approach in 2006 after we exited that first deal. We've got offices in Grand Rapids, Michigan with 9 employees, and then another office in San Francisco with 3 employees. So overall, 12 investment professionals, and about 2/3 of that group is focused on the deal sourcing, and then we've got a third that's focused on the operating performance of the portfolio companies, with approximately 15 outside operating partners who do work directly with each of the portfolio companies. We do not operate with a committed fund. We do it on a per transaction basis, and we've got 65 limited partners that are high net worth individuals, family offices, and some institutions. In the last 5 years, we've done 23 transactions for Blackford. In aggregate, our portfolio, sizes of the revenues in the portfolio companies range from $20 to $60 million, and in aggregate, it's about $200 million of revenues and $25 million of EBITDA. So, should give you a pretty good sense that we're, $30 million of revenue and 4 to 5 of EBITDA is right in our sweet spot. We're typically deploying anywhere from $2 to $7 million in our transactions, and those are typically $15 to $35 million. So we put ourselves solidly in the micro cap or lower middle market for transactions, and that has a lot of advantages and some disadvantages, which we'll talk about as we go through this. This next slide shows again, just to give more context around Blackford, it shows the history of our portfolio companies and the businesses that we've acquired. When you look at it, it would seem that part of our investment criteria is only to be acquiring businesses in the perimeter of the U.S. That has not necessarily been the case. It's just worked out that way. If any of you have companies that are in the interior of the U.S., we're definitely looking at those as well. Our current 6 portfolio companies range. 5 of them are manufacturing, and 1 is a healthcare financing company, Key Health. And we've been involved, I think the oldest one right now in our portfolio is Best, which was acquired in 2007. We've done 2 add-ons there, and then Key Health is our newest, which was acquired earlier this year. I'm going to focus a little bit in terms of where we spend our time, as a business, and that's like a lot of private equity firms. We sort of divide our time into acquiring businesses, and that's about 30% of our time, operating the companies, which is about 65% of the time, and then finally exiting the transactions, which is about 5% of the time. So that used to be a very different mix, and it's because of our effective use, I think, of the technology that we've been able to reduce the amount of time that we focus on the acquisitions and the deal sourcing from what it was historically.
Great. And is there any specific methodology, or is there a unique way in which Blackford kind of goes about its processes and its business?
Great question. On our firm structure, I think that some of this is going to be very consistent with what a lot of private equity firms do. We've sort of broken it down into 6 different processes. Sourcing transactions, negotiating an LOI. Once an LOI gets signed, moving into the due diligence step of the process. Once we've got that completed, finalizing the capital structure, making sure we've got all of the right components in that, operating the companies, and then, of course, exiting the deal. And as I just mentioned, previously, from our vantage point, we really have about, and even though we've broken it up, into these 6 processes, this first group here of 4 steps is about 30% of our time. This represents about 65% of our time and effort and resources in the operating companies, and then exiting the deal is a very small portion of our time. So we're going to focus this question or this presentation to your question, Ketan, on the deal sourcing step here, and talk through the techniques and the methodologies we've used to become more efficient and more effective with our deal sourcing.
Okay, great. And so, and I think you also mentioned that the use of technology has probably contributed to managing the 35% and then keeping that under control, or actually reducing it. And so what's been your experience with newer technologies like cloud computing?
Yeah, very good. When we initially started Blackford 10 years ago, we were it was a very different, and we'll talk about what we think of as the old methodology for transaction sourcing versus the new methodology for transaction sources. But in the old days, we were on goldmine back in 2000, and we're looking at 1,000 deals or so transactions per year, which we would record through goldmine. We had about 2,000 or so contacts that we would manage in that. And as we started to get more and more transactions, and more of the deal flow converted to online activities, goldmine didn't become effective for us. So we used a hybrid of Excel and Outlook. And that lasted through 2007, 2008, and in 2009 we were literally deluged with the number of people we had focused on deal sourcing, our spreadsheets, our hard files, and we needed to find something that was a lot more sophisticated that would enable us to really spend less of our time focused on finding the companies and more of our time focused on operating the companies. So we looked at several different technologies. There was an Act Enterprise version that we evaluated. There was Sugar software that we had evaluated. We were using Salesforce in a handful of our portfolio companies, and very much like that. We said, perhaps the best thing for us to do is to use, Salesforce, internally if we were going to do that, and that was how we came upon, Navatar, and it seemed, exactly like what, we needed and what would be a good fit for us. So we began using Navatar in the summer of 2009 to try and get a handle on it. We use it today for primarily managing our contacts, our outbound and inbound efforts. We use it entirely for deal flow, and then we use it on a moderate basis for relationships with our limited partners. At this point in time, we've got 9,000 to 10,000 contacts. A little conservative in there. We've got some redundancies, but we'll call it 9,000 contacts. We've had 8,000 plus deals that we have entered into Navatar over the last 3 years, 2.5 years, and I've got roughly 5,200 institutions that are in there. I truly do not know how we would be able to manage that with 8 different individuals that are involved, 6 that are focused on it full time, with hard copies, soft copies, files, contacts. So this gives us literally an institutional knowledge and awareness, so that we can be more effective and not be constantly searching for particular pieces of information. So today we have 4 active add-on searches that we're managing through the cloud for of our 6 portfolio companies. We've got 3 targeted proprietary platform searches, and then we have our general deal and contact management. So that's all of the other transactions that are are coming in for us. Essentially, we think of it as the deal sourcing process as an assembly line or production. And we've got 4 days of deal processing where we're trying to move each transaction, and at any one point we may have 200 deals that are live deals. We'll try and move as many of those forward as we can appropriately, try and quickly get to which ones are the ones where we're really going to be focusing our efforts. And then we'll do 1 day, Friday, of an aggregate deal review to determine, which of the companies we're going to be focusing on. And we monitor our outbound and inbound calls and emails through Navatar to make sure that we've got, the right activity levels necessary to maintain our deal sourcing efforts.
Okay. Great. And I know we've started to get some questions. Just wanted to let the people know we will take all these questions at the end. So please do continue to ask any questions you have, and we will go through all of them towards the end. And Martin, so there are a lot of, even in today's webinar, there are quite a few private equity firms who've joined in. Many smaller firms, some larger firms. In general, kind of, do you, especially for smaller firms, do you see any specific challenges that they are facing in the industry today versus, let's say, some of the larger private equity firms?
Absolutely. We consider ourselves to be a very, very small firm. We've got, I guess a large number of people or employees that we have, relative to the fact that we're a non-committed fund, private equity firm. And so because of the fact that, we are, do not operate with a fund, only, so many people within our organization, we think that we've got to do, a better job. And I think that the sense, out there in the market, and by definition, larger firms, tend to have more capital. They tend to have more resources, and there's a presumption that they'll have a higher probability of closing. I don't know if that last one is actually, true or accurate. We tend to have a post-LOI closing rate of about 85 to 90%. And I know based on our benchmarks, a lot of firms tend to be in the 50 to 60% range for what they'll close post-signing LOI. It's obviously got pluses and minuses, but the point is overall that we have to do a better job, and we have to differentiate ourselves against the firms in order to be effective in our job, which is creating great returns. So we believe that small firms can differentiate themselves in 3 ways. The first is by better deal sourcing, literally, having a lower cost, per transaction, getting more transactions and getting better deals. The second is through, adding, more value to the portfolio companies, post-closing, and being able to do a better job of generating returns. And then the third area is in, specialization and getting focused or niche industries. While we, describe ourselves as generalists, it's clear that, some industries have emerged which are, which we've started to develop a lot of experience in. So I'm going to spend some time talking about each one of those methods for differentiating in more detail. So to the first point, in terms of better deal sourcing, and we've got what I think of as some really exciting and hopefully helpful data on this that we track on a regular basis. But as we said, our the features that we provide for our LPs is, look, we are going to find better deals out there because we truly do a better job sourcing deals than other private equity firms. We've got a technique and a methodology through Navatar. We've got a system that we've developed internally, which is based on that tool. And because of that, for firms that are looking at the same relative size, we can find better companies. And just we were I mentioned earlier some of our numbers that we were experiencing, but pre-Navatar we were looking at about 2,000 deals per year. In Post-Navatar, at this point, we're able to manage about 5,000 transactions per year. We've increased somewhat the number of people that we have, but we haven't increased the number of people we have by 150%. We don't have 2.5 times the folks that we had before. So looking at the actual numbers, I'm going to spend a little bit of time on this slide right here to show you this is how we track and how we manage our transactions. As we mentioned, we implemented Navatar in 2009, the summer of 2009, and have been tracking this our deal process from 2007 through latest is 2011. So we've got what we think of as an 8-step deal process, and these numbers are, I wouldn't say 100% accurate, but they're probably about 95% accurate. We're checking it on a daily basis for the deals received, and on a weekly basis and monthly for the NDA signed and the broker calls. But for us, the deals received up until Navatar was literally exactly that. Every deal that we had had received into the company, this is on a quarterly basis, we would track and list. Post-Navatar, we actually changed that definition to deals entered, because we were simply able to receive so many transactions, and some of that's related to Navatar, some of that's related to how the general marketplace, and that brokers and intermediaries have an ability to get deals out easier than they used to. But so now it's literally just deals that we've entered. NDA signed is those where we're actually going to review an offering memorandum and spend time on it as a firm. The broker call, our transaction, or when we get on the phone with brokers to inquire in more detail about it, and you can see our relationship there. About 4 to 5% of all deals that are coming in that get entered, we're going to be spending time with the broker on it. The IOIs, indication of interest, where we want to move forward with it. Management visits are those companies where we go out and we'll actually do a visit. Generally, that happens after an IOI, but as you can see, we've done more management visits than we have IOIs. Our LOIs submitted, and we execute about half of those, and then the deals closed. This number is off relative to the total volume of transactions that Blackford's done, because of course we have deals that we had closed prior to this, and LOIs that are signed at this point that have gone through. But this gives you a sense of our process and our numbers. I think from our benchmarking that we are not too atypical from other firms in terms of our overall funnel. What's really intriguing is then if you take it and compare our pre-Navatar versus post-Navatar, and you can see a few very important trends that have occurred. So aggregate number of deals received, similar. On the NDAs signed, and what we've done is we've looked at the aggregate period of time, and then what it is on a quarterly basis and what it is on a weekly basis. So this shows the number of NDAs that we've signed per quarter pre-Navatar, and the number of NDAs that we've signed per quarter post-Navatar. And again, the same thing on a weekly basis. And you can see here that we are actually signing typically twice as many now as we had before on a percentage basis. Now that we've got Navatar, and the reason for that is because from our vantage point, we're able to manage it much more effectively than we were able to do previously. Same thing on the broker calls. We have literally doubled the volume of those that we're doing as a result of the cloud technology that we've got. So that's feature number one. We are able to manage more transactions, and then feature number two is highlighted down here. You can see that we are consistent with what I shared previously. We are looking at more NDAs per deal. So what we've done here is we've divided up how many NDAs do we have per deal that we end up closing here, and we are looking at more transactions per deal closed, but we're spending less time particularly on the management visits per deal, and that's in a meaningful way, of investing less time per good transaction. And our belief is that's because we have larger overall deal flow, we've got better deals that we're looking at, and we're finding deals that are more consistent with our criteria and our investments. So then our cost is going to be lower, because it's really, once you start to get into the management visits per transaction, that your expenses and your resources increase. So a lot of information there, but I think that's what we sort of see as the key benefits by working through cloud computing. So second way that firms can differentiate themselves and sort of separate themselves from other bidders is by offering a higher value add to the companies that they're looking at acquiring. It can do this through creative deal structures, sharing more upside with the seller, while protecting downside risk for the buyer. Operating partners and investment there, and then industry knowledge by having a specific understanding of certain industries. You can have a better should be able to contribute more value within that space. So that sort of leads into our third differentiation point, and that is specialization within industries. Again, we think of ourselves as a generalist, but over the last 5 or 6 years, we've seen that there are certain areas that we've concentrated on. First being remanufactured technology products. We've done that on the EAS side, on the toner copier side. We've also looked at a number of sort of custom engineered material firms that are finding ways of differentiating themselves through engineering. Whether it's fiberglass, steel piping, or aluminum and wood, these are businesses that have very basic production processes, but can separate themselves from their competitors through engineering. And Blackford's developed an expertise or a skill set in that. And then finally, over 2/3 of our portfolio companies have had an international sourcing or selling component, so much so that we actually acquired a business, Source International, that focuses almost exclusively, that's entirely what it does, is it helps companies in North America source products internationally, and we use them for our portfolio companies. So it's been very, very effective for us in specialization to differentiate ourselves from other firms that are out there. So ultimately, summary on this sort of section of the presentation. We have a line that we use at Blackford pretty frequently, and we say that look, these companies that are in the lower market, they know how to do one of two things. Either they know how to grow, or they know how to be profitable. And if they knew how to do both of those things at the same time, they wouldn't be in a lower middle market. They would have grown out of the lower middle market, and we wouldn't be looking at acquiring them. So by definition, the companies that we are looking at are those that are profitable, because we don't do any turnarounds, that are in mature businesses and industries that have not been able to figure out a way to grow themselves, and that's what we help them do. And it's been neat how the cloud technology and our experience with Navatar has then translated into helping our portfolio companies as they implement Salesforce. I don't think any of our companies have had Salesforce or some type of CRM program before we've done an acquisition, and afterwards all of them do. So very, very critical element for us in the equation.
Great. That also probably is a good transition into kind of the other topic that we wanted to cover, which is just in general for the private equity industry, and the perception obviously is that it's an old-fashioned industry. Doesn't really it's all relationship-based. The use of technology tends to be kind of underplayed. But kind of what do you see as the benefits of cloud computing or social media? And I mean, do they even apply to private equity firms?
Absolutely. I mean, we've seen, and I think many of the people on the call have been involved long enough to have witnessed I don't know if it's any more dramatic than what's occurred in other industries, but so much of private equity is based on who you know and being able to network and identify companies and businesses, broadly. Our purview is in North America. And 10 years ago, sometimes even 5 years ago, the old way that private equity firms operated is they would have, a number of strong relationships with a smaller number of individuals, and when those individuals would, have a transaction, they would bring it to, a smaller number of private equity firms. And there were some out there, beginning, 10 years ago, that were able to go with a broad approach, but they would do that through a mailing. That database was unique and was proprietary. But there was a lot of time and effort spent, nurturing each intermediary relationship. And you also had a unique business model where there were a few companies that were focused entirely, and some of them still exist, but we see far fewer of them today than what we saw, in 2000 and through 2005, where it was a buy-side broker, and their job was literally to contact all of the sell-side intermediaries and get a list of the companies that they were selling, and then they would contact the private equity firms and say, oh, I've spoken with 500 or 1,000 intermediaries, and I've pulled together all of the companies that they have listed for sale, and now you can buy from my list, and we'll take a Lehman or a double Lehman formula for compiling that list. Today, it's very, very different. I think most private equity firms are managing 5,000 to 10,000, and some even cite 40,000 intermediary relationships that they have out there. And I think that more of the time is spent on evaluating the transactions that come across as opposed to working with each intermediary. But quantity as opposed to quality really becomes the driving factor, I think, in today's deal sourcing efforts. Short phone calls that occur on a consistent basis, just to make sure that they're aware of us or the private equity firms, and vice versa. You get email blasts that come out, and firms are simply able to source more companies, just as we have been able to do so. So I think there's a lot more transparency, and that's why those requirements or features that we had mentioned earlier in terms of differentiating become that much more important. So I think there's also networks that are being established in social media where you've got more of a free flow or exchange of ideas and in the private equity world, transactions. And so for example, Navatar is coming out with Deal Connect, currently in beta, but which links the buyers and the sellers. Now the differentiating feature is not going to be who can find the transaction, but what is the value add, what's the price that's going to occur. The bad part of that is that from our vantage point, the pricing becomes a lot less irrational. It's harder to find the good deals, and therefore the requirement for each private equity firm to do a better job operating their portfolio companies is even higher.
Great. Now, I mean, having said all this, and given kind of the use of technology, do you kind of have a sense on what competitive advantages does the use of cloud computing or social media or any kind of technologies is that providing either to you or to the private equity industry in general?
Absolutely, Ketan. We've got three primary competitive advantages that we've identified using cloud technology, and we think these competitive advantages are, have been ours for a few years as cloud technology and Navatar becomes more prevalent. We're simply going to have to stay, ahead of the curve and work smarter with it. So we've got a 2.5-year institutional knowledge on Navatar, and we'll continue to push the envelope forward and look at a variety of tools that we can use. But The first, as we mentioned earlier and showed the actual numbers is we are tracking more deals using fewer resources. So our productivity, in transactions, per analyst or investment professional at Blackford, we've increased the productivity, and that's good, very good. We also, I think, can, as a small firm with fewer resources and fewer people, we can be in touch with the same number of investment bankers, intermediaries, accountants, lawyers as larger firms can, because we are using cloud technology. And then the third is because we have less resources, cost is very important to us, and so we are able to lower our costs using cloud computing. And there are two specific areas. These are not an exact science. We work very hard to make sure that when we present numbers that it is accurate, but so we don't employ activity-based costing at Blackford to assign a dollar amount for every hour of time that is spent. But our back-of-the-envelope calculation is that we're saving about $30,000 a year, and that would be part-time for an IT professional who would be overseeing our deal sourcing infrastructure. And we don't have that expense because we're using cloud technology, and Navatar handles a lot of that. And then the other one that's also fairly dramatic is our analyst cost savings. So if we take and again, we're not using a single analyst for our deal sourcing, but if we were, $100,000 assumed analyst salary, when we're looking at 2,000 deals per year, that's roughly $50 per deal. If we're using 5,000 deals a year, that's $20. So we take the total savings in $30 per deal. The additional amount that we're able to see gives us roughly $150,000 or so savings that we'll have. So we think we're reduced the amount of people by 1.5 analysts. So those are some of the competitive advantages that we have been able to see as a result of using Navatar. Last little bit, I know we're sort of moving into the time when we want to get the questions answered, but I want to spend probably do this in 3 minutes here on how Blackford has used Navatar and the specific ways in which we're employing at our firm. The first is on deal management. We look at a regular pipeline. We've got information fully aggregated into our database, and then we say in each of our phases that we had gone through previously, deals that we're looking at, when we're talking with we signed the OM, we're having conversation with the broker, the IOI, what are the steps, and what is it that they need from us? And so we've got all of those things flagged. We've got some reporting activity reports that we can look at, which also tells us, which intermediaries we've been in touch with and who we've not, which intermediaries have been showing us more deals that fit our criteria and which have not. So we've actually developed a ranking of intermediaries for us on A, B, and C. And those that are A, we like to be in touch with a lot, and those that are C, we spend less time on them. And then from a communication standpoint, we feel that we're able to keep records straight of where people are, which firm they're at, what their contact information is, who else is there at their firm, prior deals that we've looked at, at their company, and then internal communication. And it still happens even with cloud technology, but it's always embarrassing when we're calling someone at Transworld Business Brokers that we've completed a transaction with, and we've got a new analyst who says, hey, we wanted to introduce you to Blackford Capital. And I say, wow, we actually just closed the deal with you a year ago, so we're pretty familiar with who your organization is. This cloud technology helps us handle that better internally. So you can see on the reporting and tracking, this is a screenshot and a dashboard, and goes through some of the the highest priority ones that we're using. All of our contacts that are in there. That's the first one, our deal flow dashboard, which shows the metrics for our firm, the number of contacts we've added over time. Down at the bottom, the senior We've divided that into different categories for senior, but then also mezz firms, and then our call volume that we have for outbound calls. And that if you look at that and see our outbound call efforts over time while we've used Navatar, increases on a pretty consistent basis, and then also our contact tracking with the different categories that we've got there. You can see how those have increased over time for us as well. So in summary, we think that the world is changing, that there are new requirements and new rules for private equity firms. As a result, small firms and large firms need to adapt. It can be harder for small firms to do that. And as a result, you've got to have tools that allow you to do a better job using fewer resources and put you in a position such that you'll be more effective and able to generate better returns than the competition out there. And cloud technology has allowed us to do that very, very effectively. So that's our story. Ketan, I'll turn it over to you. I know you've got a number of questions that we'll be going through.
Yes, we actually have quite a few questions. So what we'll try to do for the audience, we'll try to go through and cover as many as we can. And Martin, I guess we'll just, in the interest of time, we'll try to keep the answers brief so we can cover as many questions as possible in the next 10 minutes or so.
Great.
So the first one is a question: whether do your investors have discretion on the decision whether to invest or not invest in a particular deal?
They do. Of our 65 LPs, we have probably have a quarter that are in every transaction that we've done. We've got half that are in more than one, but less than all, and then we've got a quarter that are probably in one transaction. So they do have that opportunity. It's part of our model, and it has its pluses and minuses. I think our LPs like that feature, that they know that they've got some say at a large investment committee, if you will. I think it makes us do a much more thorough job in terms of our scrub and our due diligence. That's another part of the process that exists. It also holds us very accountable for the transactions that that we have invested in to make sure that we're always performing well on all transactions. So those are the good parts. I think the challenging part is we have lots of communications and lots of dialogue with each LP. If you figure that there are 30 LPs per transaction or so, 40 LPs per transaction, at this point times six deals, that's sort of 240, 250 touch points that need to be handled and managed. So it's certainly a lot of time, which is why spending time on governance and fund administration, because we're spending less on deal sourcing, we can spend more time on that.
Okay, great. The next one is our firm is evaluating cloud software. So what questions should we be asking?
Well, I think very good. I think that one of the things that you'll need to ask and evaluate is your current process that you use, and how are you doing it, and how can you get a technology that's going to support that process. It took us, we're a smaller firm, so it's not like entirely comparable to implementing a new ERP system at one of our portfolio companies, but it does have some similarity to it. So I think the first question to ask is, what's your internal process, and can you get a technology that's going to support that? Second is, what are the functions and features that you need out there? There are certainly some less expensive feature options that you've got, and we looked at those and tried to compare it in functionality. I guess from our vantage point, finding one good deal, more than we might have otherwise, is definitely worth it. And so we're willing to spend a little bit more than the cheapest stuff out there, which is either free or $50 per user or something like that per year. So first question is what's your internal process? Second question is what functionality do you need? Third question is how much on a cost basis do you want to spend, and what is the return on investment that you'll get by spending slightly more.
Okay. Next question. What is the average EBITDA for the companies currently in your portfolio?
Well, 25 divided by 6 is going to be what, 4.16?
Okay, great. Next one. You talked about how smaller firms can benefit. But what about the larger firms? Can they benefit from the cloud too?
Yes, absolutely. I think that it's really, how critical is deal sourcing and looking at opportunities to your organization. I think that larger firms, and this is a general statement, but and certainly doesn't apply for all companies. Larger firms, because they're larger, will have more capital, more resources. That's certainly the case in the private equity industry, and may have been effective before, or more effective before relative to the smaller firms. I think the smaller firms are the ones that will need to adapt to it quicker or sooner, or have adapted. But certainly today, there are a lot of large companies that are using cloud technology, working with Navatar, and I think they'll be able to do the exact same things that we do. It's a tool. Just because you're a small firm doesn't mean that you're the only one that's able to use that tool. Eventually, we envision that there will be it'll be pretty much standard across all businesses. There is probably a few platforms that people are using, and but pretty much everyone will be on the cloud and private equity for deal sourcing.
The next one is around social media. So the question is, are you affected by compliance issues when you use social media? And if so, how do you monitor any social media activity that your firm does?
We haven't come across any problems with compliance on social media. We have also probably not, and I don't think we're atypical in this, but probably not been as aggressive on a Facebook or a LinkedIn with our portfolio companies. We do feel that information, it is private equity after all. We do feel that information is confidential. On the deal sourcing side, we're working on using that and intend to continue to use it and be more effective with it. I think that there are already LinkedIn private equity subgroups, and where that's our sort of next frontier for us is to get involved in that on a more regular and consistent basis. But we would probably be pretty wary of sharing existing information on our current portfolio companies or exited transactions on there.
Another question actually on one of the slides where you had the metrics. So this, I don't know if you'll be able to answer on the fly or something. You'll have to go back and look at the numbers. But the question was, weren't the 2 deals closed in the first quarter of Navatar really deals sourced from the pre-Navatar period, as there were no LOIs in that third quarter? So not sure if you have an answer handy, or is it something that you probably have to go back and look at the numbers too?
Oh, no. I mean, that's definitely right, and I may not have spoken to that as much. I made a brief comment on it, but, I mean, LOIs will take, if we're really effective and the seller's all set and prepared, you can do that in 45 to 60 days. We found in some situations sellers aren't quite as prepared. Banks can take a while, holidays can creep in, and so it can take more time than that. So yes, absolutely, the deals closed originally. Afterwards do make it we're pre-Navatar, so then that raises the questions on, well, gee, how effective are you with it? I said that can you really then say, given the small base on the number of deals that we've got, that our figures are accurate? This is the best we could do, and in showing that. I am highly confident that if we were to do a period-to-period comparison on transactions that we've got, on deals that we've been able to review, and our time where it's spent closing, that Navatar has been highly effective and functional for us. But that is a fair point in terms of the specifics on the numbers that we presented.
Okay. The next question is, will you be forming a fund? And if so, then when and what do you see as key issues and the effect of using a cloud service? But I guess the main question is, will you be forming a fund?
We absolutely intend to do that. We'll probably do that in the late 2012, 2013 timeframe. I think our model has worked very well for us thus far. We've really been pleased. Our LPs have really been pleased, and if it's not broken, no need to fix it. But as I mentioned earlier, as we get into 10 portfolio companies and 15 portfolio companies, it'll probably be easier to communicate with our LPs on a fund basis. And at that point, I think it will be appropriate for us to migrate to that business model. But it's worked very well for us, thus far. And in the short term, we don't plan on changing that.
Okay. I'll try to squeeze in a couple of more questions quickly. The first one was, I understand that Navatar helps manage the process and contacts, but how do you, one, populate your database, and two, do your due diligence?
The first, on populating, that is a really good question. We went out and we purchased some databases. We attended a lot of conferences. We did internet searches. We got some assistance from various individuals or firms within certain geographies. And even today, we're still finding that there are more people to complete more people that we need to add to populate the database. And then of course there's always cleaning of the existing database. People that are no longer there at the at the firm or have moved to another firm, or people that have been added. So so the first part of that question, how do we populate it? It was literally just work going out, and you can see, I think, from that from that slide, which shows our down here at the bottom right, it shows our contacts over time. This part, whoops, get the highlighting feature. This part was a lot of work at finding those those companies and those businesses. Once we've started, now that we've got it, we just have a very steady increase of several hundred per per quarter that'll come on, and then of course all of the changes and edits that we need to make for everyone that's in the database. To the second part of that question, in terms of how do we do our due diligence, I think that's probably a topic for another time. We are not currently using Navatar in that, but it generally tends to be 3,000 to 5,000 hours of firm time that'll go into that, firm time and outside resources. It's a like I said earlier, if we do a great job, 45 days, and if we do if factors get in our way or there are obstacles that are tough. And we've had deals that have taken as long as 130 days to get closed. But we have phase one is Blackford doing its operational and financial due diligence. We get our own internal deal review and a financial model. Phase number two is the outside providers doing their due diligence. We use market research, customer evaluation, accounting, legal due diligence, sometimes environmental, IT due diligence, and then there may be other special components that we have. And then the third process is the final documentation when we've got the senior and mez, if necessary, in place, and go through the documentation with all of the various parties and constituencies. And that usually takes, again, if everyone's focused on it, 3 to 4 weeks to get that part done.
Great. I think we have time only for one last question. Can you talk a little bit about LP relationship management, and do they access reports and other information through the system, and we probably may need to just wrap it up in a minute for the answer on this one.
Sure. We do some LP communication here. We've also got our own FTP site that we use, which is accessible via our Blackford's website. And on that, we have weekly KPI reports that we do. We've got monthly financial reports that are posted. We've got quarterly board meetings that are posted. And on the monthly calls and the quarterly board meetings, those get recorded, and the recordings get posted. And then for each portfolio company, we have a semi-annual LP conference call. So 2 times a year, we have the management team present for 90 minutes in a webinar format to LPs that are invested and involved in that particular transaction. So it's worked very well for us. And then, of course, whenever an LP has a question, comment, a concern, we work to be very, very responsive to them and ensure that we're able to get their questions answered as quickly as possible. So I think on the governance side, we feel that we do a very, very solid job on that, and we have used essentially, cloud technology. ShareFile is the specific technology that we use to manage that. So I think we have over probably 350 different connection and touch points on that, including the bankers, the mezz firms, the lawyers, the management teams, Blackford's participants, outside service providers, audit firms, and the LPs that are accessing that part of cloud technology. But we'll have to do another webinar to get into detail on how we handle that. So I think, Ketan, we are out of time.
Yeah, we are out of time. There were still a few other questions. So what I would encourage anyone who still had questions that we couldn't get to, feel free to reach out to Martin. Martin, if you don't mind, just the last slide where you have your contact details. If you could have that displayed. Yeah, so anyone with any other questions, feel free to reach out to Martin. His information is there, or to anyone at Navatar too. Thanks everyone for joining. We really appreciate your participation, and thanks a lot, Martin. I think this was great, and we welcome your contribution here.
My pleasure. Thanks everyone for being involved, and I'll be very responsive to anyone that does have questions for us. So thank you all.
Thank you, and enjoy your day.